Modern finance operates in milliseconds. Algorithms parse global data to execute thousands of trades before a human can blink, reacting to daily headlines and attempting to profit from microscopic price movements. But forecasting how a massive corporation will perform based on an afternoon's price fluctuation is nearly impossible. The sheer volume of variables makes short-term trading highly unpredictable. Yet, the most successful investor in modern history ignored that entire ecosystem. Warren Buffett built a conglomerate worth over $1 trillion by refusing to participate in the daily panic. His approach filters out the hysteria. He treats stock tickers as the relevant noise, focusing entirely on the underlying economics of the business. To understand how these results are possible, we have to look past the ticker tape and reconsider the basic definition of ownership. A stock represents fractional ownership of a real business, not a blip on a screen. A speculator gambles on whether Priceline goes up or down. An owner evaluates the factory, the product, and the cash flow. Buffett shifted his entire strategy when he realized a simple truth. Buying a wonderful company at a fair price yields far better returns than buying a mediocre company at a steep discount. He stopped looking for quick, high-risk payouts. He started hunting for businesses that were inevitable, companies whose products would remain essential regardless of the economic climate. This perspective turns investing from placing chips on a roulette table to taking permanent ownership of global value. To find these companies, Buffett uses a rigid three-part filter. Most market opportunities fail to pass, and he simply walks away. The first test is the circle of competence. If he does not clearly understand how a business generates revenue and incurs expenses, he rejects it immediately. Complexity introduces unmanageable risk. The second test is an economic moat. A strong business needs a durable competitive advantage that repels rival companies over decades. These protective layers take specific forms: absolute brand loyalty, a massive physical distribution network, or the ability to raise prices without losing customers. Applying this strict filter eliminates almost every asset in the market, leaving only a very small handful of resilient, highly profitable organizations. The final piece of the checklist is the margin of safety. Even the best business must be purchased at a price well below its actual intrinsic value to protect the investor from unforeseen market shocks. Following the 1987 stock market crash, panic drove prices down across the board. Buffett saw a clear margin of safety in Coca-Cola and began acquiring shares. He recognized that their global distribution network and intense brand loyalty gave them immense pricing power. Over the next several years, he invested over $1 billion into the beverage maker. This chart shows the initial billion-dollar investment remaining completely flat compared against annual cash dividends. After buying, Buffett took no action. By ignoring market fluctuations, that single position now generates over $800 million in cash dividends every year. Stoic patience drives exponential compounding. The wealth comes from the holding, not the trading. This logic translates perfectly to the modern era. In 2016, Berkshire Hathaway began heavily purchasing shares of Apple, a technology company, a sector Buffett had historically avoided. He recognized that the iPhone functioned as a consumer staple, protected by an ecosystem of apps and services that made the device essential to its users' daily lives. The system, however, is not flawless. Buffett misjudged IBM, purchasing a large stake under the assumption that their deep entrenchment in corporate IT was a true moat. He later exited the position after realizing their competitive advantage was deteriorating. He also missed Amazon's early expansion into a global retail force. He admired Jeff Bezos, but strictly refused to invest because the e-commerce and cloud computing model sat firmly outside his circle of competence at the time. Yet the portfolio survives and thrives. Strict discipline and an absolute refusal to use borrowed money protect his capital, ensuring that missing out on an opportunity never results in a fatal loss. The financial industry often sells the idea that success requires complex formulas and constant activity. The reality is, it requires emotional control and understanding basic business mechanics. Time in the market consistently beats attempting to time the market. Wealth generation relies on finding durable value, holding cash reserves patiently until the price is fair, and letting compounding do the heavy lifting over decades. You do not need billions of dollars to adopt a business owner perspective. Evaluating an asset based on its cash flow and competitive strength works the exact same way for an individual portfolio. Navigating emotional market cycles and calculating fair prices can be difficult, which is why seeking structured guidance is an effective way to maintain discipline. Securing a financial future does not require predicting tomorrow's market noise. It requires owning what is inevitable and having the patience to hold it.